part of our boot camp will be, I'm going to be going through how we present managed accounts to people. Because like our closing ratio is like 99.99%. I mean, we missed one person in the last 7 years and they changed their mind and switched. So it's an effective presentation. I'm working with them on a couple words yet because they changed a couple words I wish they wouldn't have, but we can live through it. But I'm going to still work with them a little bit and see if we can. So a little preview of something that's going to be coming in January. Hey, I love it when y'all have your cameras on. Now, Joe, you're not freezing in Hawaii, are you? Right? You're not freezing to death or nothing, are you, Joe?
No, right now it's 75, but once the sun comes up, it'd be like 80. Yeah, we're good.
Yeah. Okay.
I got my
Joe.
fan on right now to kind of keep the room cool.
We have our heat on. We moved into an office. Hey, Duncan, 3 years ago, a different office. I got here this morning. I always get here at least 2 hours early and review and do prep and try to fix stuff and see where I screwed up. And it was 59 in my office this morning, Joe. Yeah. I know like you'd have been like breaking fingers. It's, people are saying, well, market can't go up again. I beg to differ. Okay. I beg to differ. So let's look at a few different articles. Again, you have a little reading in the first part. It's better than me trying to read you. I can barely read. So anyway, this is a brand new one, hot off the press from December 10th. And you're seeing all of the big banks and the investment firms are going, market's up. I'll let you just read a second.
You don't teach reading at Brooklyn or what?
No, I didn't go to Cooley.
Easy one.
I can't read either. Braille.
Ooh. Almost.
Yeah. So you see some big calls there, some big numbers, some big stuff. Okay. Now, if there was only one article that talked about that, okay. But, okay, here's an interesting article, right? The average bull market is 5.5 years going back to 1950. Okay. So if you look, the current time frame we're in, right? We're just in the bull, not average yet. So if you look at history of how much S&P goes up during those, it goes up an average of 191%. We're only up 92% as of the end of October in this current bull. So this also would say, hey, there's room to go, and I love articles that give long history. Okay. Not like, okay, here's what we think last week. No, here's like 75 years. Okay. That's a pretty good thing, right? Now, here's a few weeks ago, another article saying the same thing. I know I got them in reverse order, but I'm starting with the newest one, but saying, hey, we see the market going up. We see the market going up. Okay. Here's another piece, right? That's a kind of an interesting piece. I'll let you read this. We'll spend a minute on this one. So if we look in this section, it says in the 579 times this has happened. Okay, that's a lot. Okay. So the 579 times this happened, the market goes up with dividends just about 10%. That's normal. Okay. But look at this. Look at the second to the bottom one. Okay. When it's gained at least 10 over the prior 12 months, it's up with 13 at the time of the article. The numbers were virtually the same. In other words, when the market took that downturn and people start getting nervous, there's not a lot to be nervous about, right? Since 1950, they're giving you facts to show you this is normal. And I got a bunch of pieces like in here today. Again, I'm gonna try not to make your eyes roll back. But part of the reason why I'm optimistic all the time is I do the research, I do the study, and I look at all the numbers and go, what is there to worry about? The market goes up, the market goes down. It goes up a lot more than it goes down. Okay. Another article. Huh?
End presentation.
Yeah.
Goes up, it goes down. Goes
Yeah,
up,
exactly,
goes up.
exactly, right. So here's a November 17th article. Same thing. They're saying they were predicting we see the market going up. So people were saying this right after the market took a little dip. Not only now when the market's recovered and set a new all-time high again. So like, hey, we're positive. We're positive. We see things going in the good direction. Okay. Another article. All these, like you're seeing November forward, there's a lot of press, a lot of people going, hey, we see, here they see the Fed helping, here they see Trump helping. And I like the last point, Gen Z, right? They have a fear of missing out. They buy in the dip. Okay. I like that. The older people, okay, they all panic. I don't panic. I invest like I'm 20. It's like, whatever, doesn't matter. Okay. So let's talk about market timing. I got some new things for you, some old, some new. Okay. But when I was preparing for today, hey, Justin, when I was preparing for today, how's your wife?
Is
All right. So just got to check it. One of our reps' wife got vertigo and like spent a bunch of hours in the hospital trying to overcome that stuff. So excuse me for all you that ain't live. Okay. So when I was doing the research for this and I was going through a whole bunch of different stuff, I had a memory of a few years ago and I found the training module. Okay. And I want to show you some really interesting stuff. This is from a boot camp we did in March of 2022. Now, what was going on in March of 2022? Anybody remember? Yeah, the market was going down. The wheels were coming off, right? Good morning, Dano. The wheels are coming off. Things were like not looking exciting. And I know I did a boot camp and I did a call and Brad had to be sending some stuff for MPI and that. So again, let's not be nervous. This is a Primerica brochure, 521. These are the actual slides. Okay, the first few slides showing what happens after a market low. And if you can see, the average return 5 years after a market low is 19%. Okay, that's the average of the last 7 market lows. Okay, at the printing of this article. This slide was the following slide. Okay, exactly like it was.
Well, that'd been COVID right there, right?
Yep.
Okay. What?
So I was going, here's what the market's going to do by March of 2025. Okay. Now, at the time, listen, I'm not smart. I just use history and facts. So at the time, the Dow's at 18.5, and I'm going, it's going to be at, 40, 50 in 5 years. What do you think most people, what were most people thinking the reality of that it was going to be?
They're nuts.
No, you're nuts because the world is coming to an end, right? The world is over. I mean, as we know it. Guys, that's happened a zillion times, okay? So, interesting, okay? This is a slide I made to add to this. Where was the market in March? 43,191, right between the lowest and the average. Where's the market today? 48,000. So off by a few months to get to 48 from the average.
No.
Yeah, go on back, coach football for a living. Okay. So, I might have an extra slide in here. We'll see. I had all kinds of stuff in here and apparently I forgot to delete the next one. So the goal is for you to be confident in what we're doing. That's why I do stuff like this, like all the time. I want your confidence level to be unbreakable when people are like panicking and there's a meltdown. And because listen, you're going to see some ugly stuff in your career. That was pretty ugly. You're going to see some ugly stuff in your career. When you can keep people in during those times, you earn a lifetime client at that point. because you keep them from making a detrimental mistake that could be devastating to them. We're going to have an example of that. Okay, good thing I had that in a third time. It's always important. Okay, we're going to talk about market timing. And I've got some new slides in here and some of the stuff that a bunch of people haven't seen. You've seen this one like every month forever. I keep beating that into our heads because market timing is pretty irrelevant in the game of investments. If you happen to hit the right time, you look super good short term. But over the long term, it's not that significant. So let's start out with a new article. Okay. So the Dow's up 1,200% since a March low. There have been 31 corrections of 5% or more. Here's the 31 corrections, but look at the statement here. Far more money is lost by investors preparing for corrections or trying to anticipate them than the actual correction. That was Peter Lynch. Now, some of you don't know who Peter Lynch is. Notice the average annual rate of return of 29% a year for 13 years when he ran the Fidelity Magellan Fund. Wow. Wow. Okay. This guy knows what he's talking about, obviously. And I believe I talked about last month did I talk in Bootcamp about the client's son who called him and said, get out of the market?
Mm-hmm.
Yeah, okay, yeah. So, how happy is he that he stayed in the market? All-time high, everything's up. He's okay. We can't let, are you all right, man?
Yeah, I'm saying.
Okay, we can't let emotion control people. That's what we get paid for. A line that I'll use, like if I'm talking to Braden and he's panicking and nervous and flipping out, Braden, an advantage you have to having me being your advisor versus you doing it yourself, I'm not emotionally involved in your account. To me, it's complete logic. Have you ever made an emotional decision and later regretted it?
Oh, yeah.
We all have, right?
Yep.
Yeah. Don't you wish you'd had logic at that point in time to stop you from doing that?
Yes, 100%.
That's what I'm for. So I'd like to encourage you to trust what I'm sharing with you, not make an emotional decision. Does that make sense?
Yes.
Can we work together on that?
Yes, sir.
So that's verbiage to talk to somebody when they're like having a meltdown, freak out. Because all of us have made emotional decisions that we went, that wasn't very smart. All of us. And our job is to keep people from doing that. Okay. Next piece. What has the greatest impact on investment results? Right? Investor behavior. 19, this is the last 30 years. The market returned 10% over that 30 years. Bonds returned 4.4, yet the average investor got 3. Why did the average investor get 3 during that time frame?
In and out.
In and out of the market. In and out of the market. Trying to time it, trying to figure it out, panicking. Okay. Inflation was 2.5. So if they got 3%, if they were in non-qualified funds, in all likelihood, they lost purchasing power to inflation over that 30 years when 10% was available for everybody. If they just put it in, forget it. Okay. Powerful article. This one is maybe stronger. Okay. On the left, missing the best days. Okay. Missing the best days during this time frame, right? Look at if you miss the 60 best days, you got a 0.6% return. The 40 best days, a 3.2% return. But looking on the right, that's the one that's most interesting to me. Okay. Many of the best days occurred during periods of volatility. The S&P 500, the 30 best days since 1994. Look at the center 2 sections, the financial crisis and COVID. How many, right? How many of the 30 happened during those 2 traumatic times? The vast majority. So look at number 1, 10/13 of 08, the market went up 11.6% in one day. Okay. Look at Look at 2 weeks later, it went up by 10.8 in one day. And that happens to be at the time with that article we used from Warren Buffett that was in the New York Times, October 8th article, talking about chillax, calm down, everything will be okay, hang in there. And he said that at a time when it was max, it was the worst downturn since the Great Depression, a 40% pullback. Okay, 54 from the high, from the peak. It was ugly. Okay. But if you and I were doing our job and we kept people in and dollar cost averaging through that time frame, they came out smelling like a rose. Where on their own, they panicked. I mean, there were people that didn't retire because of that. You know, your and I, a job as an advisor is not to let people get crazy. I'm going to give you an example. I haven't used this one for a long time, but long-time clients, the wife's husband dies. He did all financial planning stuff. She was a train wreck, which she had a right to be a train wreck. That wasn't meant as an insult. She just lost her husband, long-term husband. The sister and her husband bring them into me and sit down. She's bawling walking into my office. And they tell her, you know, this is Kurt. This is the guy we're telling you about. You can trust him. He has all of our assets. They got a few $1,000,000. He has all our stuff. You can trust him. So I worked with her and helped her. And we ended up investing her money. We also found the state of Wisconsin tried to mess her out of some cash, but we went to bed and got it from her husband's retirement. Okay, so pay attention to what we're doing here. She's a client for a couple of years and the market's doing really well. I had put some money low key, like moderate growth, and then some growth. Because when she sat and met me crying, I can't lose. I'm going to use Isaac as the husband's name. I almost said the husband's name. I can't lose Isaac's money. She was like vehement. So I put Isaac's money in moderate growth. A couple years later, the market's doing really well. She comes in for an annual review and she wants me to get aggressive with Isaac's money. And I reminded her of the objective of the plan. I reminded her when she came to see me, and I didn't let her, when I say didn't let her, I can't stop her. She followed my advice and did not get more aggressive with that. Okay. She's turned 700 grand into $1.8 million with us. Okay. And she's happier in a pig in a slop. But I did not want to let the emotion of the market doing well. So I asked her the question, has your goal changed? Has your objective changed? No. Well, then we shouldn't change what we're doing. We're on track with the goal. So it's easy to be excited when the market's doing well, and it's easy to want to like crank it up and get crazy. Remember, the other side's coming also. We got to teach people to plan for everything. Let's talk about some more stuff about the market. Okay. I found this is really interesting. 92% of the time from January 50 to December 2025, 92% of the time the market's in a drawdown. In other words, it's coming down from the high. 92% of the time. I never had realized that. It trends up, but 92% of the time it's retreating from the high. So it kind of blew my mind. I kind of your same reaction, Isaac. Like I really didn't even ever think about that. I had to sit and study that a while ago. What's that mean? So when we see it, so we should be preparing clients for volatility. We should be preparing them for that. Everything's not going to be great all the time. It's not going to happen. I was going to remember break to find out how many people are going to eat and text mom. Okay. So thank you. So we got to, I think it's a great piece. Another great piece about drawdowns. Okay. And this is from 1928 through November of this year. 100% of the time, the market's got a 1% pullback. Look at 10%. 64% of the time, the market's got a 10% pullback. This is not abnormal. The problem is when the clients get used to the market going up all the time, Justin, they forget it's going to retreat sometimes. And that's when the bankers and the insurance scam artists jump on people with fixed annuities and index annuities and all that. I just said some of you, well, this is not MPI, this is boot camp. I'll say things different here. I do not like index annuities. I refuse to sell them. I think they're a poor product person. But if you like them and you have success, keep doing it. Okay, okay. So I kind of said something there without disclosing that to y'all. All right. Look at 20% returns. 27% of the time, every 4 years, there's a 20% pullback. This is normal. So having things like this to be able to show people this is normal. This is what happens. This is nothing to be nervous about. If it's something that's never happened before, I get it that you're nervous, but it's like happened a lot. It happens every 4 years. So there's not a lot for us to be concerned about. Let's talk about midterms. There's talk about that, okay? Look at this statistic. Look at these averages, 1950 through 2024. The first year in office, right? The market average is 11. The inter-year pullback is 12.9. That's where we are right now. The midterm year, the market averages these are returns a year after the pullback, right? The biggest pullback is during midterms, but the biggest recovery is after midterms, right? And what's interesting is, I don't think that's in this article, 0% of the time after a midterm has the market ever been lower after the pullback. 0% of the time. Okay? It's 100% of the time it's higher. That's on a different chart I took out because I thought I had too many charts at some point. Right? So people are, when I'm meeting with clients, I'm talking to clients, I'm expecting some volatility next year, but I'm expecting it to end well. But I expect some volatility. So I'm telling people that. So they're preparing for that. Okay? We're almost done with all these different articles. Okay? Bear markets, right? Look since 1945 through the end of 2024, look at the number of times it happens in the recovery time it takes coming out of those. So again, if it's like, oh, it's never happened before. No, it's happened before. It's happened before. So I don't see a bear market maybe a couple years from now, maybe, right? But not now. Don't have a reason to be nervous. One more on bulls and bears. I think we're getting through all these. I can tell that it's like I'm like the boring school teacher here, just about. All right. Yeah, Isaac, that was good. If you can see Isaac's eyes right now, he's got his eyes crossed like he's killing me, Smalls. Okay. So bulls and bears, 49 through to June of 2025, right? Average bull, 5.3 years, 254% gain. That's bull. Average bear, 1 year, 31% downturn. I would take those odds every day. So, and again, it's a study going back to 1949. So it's not like, oh, this is brand new. This has never happened before. So again, the goal from this is to give you complete confidence. If you put together an allocated portfolio that matches the client's objective, they're going to win. Not every year, but they'll win. Okay? You don't have to win every battle to win the war. Okay? You just got to win the majority. And in the market, people win the majority. All right. On MPI, I screwed up the following one. I screwed up some. I put it in here, and I'm on MPI on Thursday. I don't know if I'll put that piece in again or not, but for those of you lucky enough to have been in the business during the greatest downturn since the Great Depression, this is a great piece to give you confidence, because in your lifetime, you probably won't see it this ugly. Okay? A person puts 100 grand in, they're your first investment client, Justin. They put 100 grand in 10/9 of 2007, right? The market's Aurora, and you're like, right? And 3/9 of 09, their 100 grand is 52 grand. Okay. How are they feeling about Justin right now?
Too small.
Yeah, he's got a black eye. Okay. This is where you earn your money, folks. Right here. This is where you earn your money. All right. Is keeping them in. The objective didn't change. The share price changed, but the objective didn't change. Okay. So what do? If they panic and take the money out, okay, versus if they leave it alone. If they leave it alone, it took exactly 3 years. It was 100 grand again. Took 3 years to recover. Okay. But if you look, CDs have averaged about 3% since then. The appreciation averaged 14 since then. Their $100,000 initial investment is back to $83,000 at the end of 2024. Their investment with you, keeping them in, is worth $445,000. Most of you will never be an advisor to be this unlucky and have that happen. Okay. But have confidence. If their objective didn't change, stay with the plan. Don't be switching the plan midstream because things are ugly. Now, might you change a fund? You might change a fund if there's a reason, if the manager changed, whatever the case, but the objective didn't change. Going from the market to a CD, you're changing radical change. If the objective is still growth, the CD will not do it. And they want to take the money out of the CD, put it over there, give the market time to recover, and then get back in again. They want to buy high. When the market gets down, they panic, get out. They want to be on the safe side until the market recovers and goes back up. Now they feel comfortable. Now they want to get back in. That's not how you make money. Yet that's why those articles I showed you earlier about why investor behavior is the problem. That's it right there. Now, logically, I suppose if you don't understand stuff, it could make sense to get out and secure yourself, and then when it's doing good, get back in again. But it doesn't, or emotionally, excuse me, but it doesn't make any sense. So have confidence in your objective and what you're doing. Have confidence in your strategy. If, again, a well-diversified portfolio that matches the client's objective. Okay. Interesting. I found some old stuff, so I pulled another old one out, but updated it till today. Okay. This is when we moved our office. I found some old newspapers. Okay. This is September 15, 2003. The Dow is at 94.71. Okay. In September of this year, the Dow is at 46.3. So the Dow had went up 4.9 times. If we use that same thought process, right, in September of 2047, the Dow will be at 227,000. Now, when I say that, does that seem, newest guy in the room, does that seem reasonable to have the Dow at 227? No, but it's a 7.24% rate of return between now and then. Does the market do better than 7.2?
Yeah.
Okay. How about the S&P? Okay. Same newspaper article, right? I used to get the USA Today. I thought I was smart. All right. So the S&P was at 1,018. It grew to 6615 exactly 22 years later. Okay. So if it keeps growing, that was 8.53% for that time frame. If that keeps doing that, right, the S&P will be 42.9 in September of 2047. They're talking about getting to 7 or 8 next year. That seems unreasonable, but it's a below average rate of return for the last 88 years. So many, many years ago, this is Benny, right? I remember when a person had predicted the Dow was going to be at 10,000, and that seemed like, how can you say something like that? Stuff just can't keep on going up. And he provided the analogy. I'm really not very smart. I just took the long-term average of the S&P 500, or I'm sorry, that long-term average of the Dow, and just extrapolated out until it got to 10,000. Oh, okay. The numbers seem ridiculous, but it's just the average. Okay. It's just the average. There was a time when the Dow, some of you have been in the business a long time. There was a time when the Dow 10,000 seemed unreachable. It seemed impossible. It just couldn't quite get there. Now we're on top of Dow 50,000. All right. So what about this? What about gold and silver? Oh my gosh. Hey, gold has killed it this year, folks. Gold has killed it. Right? So now this is my opinion, which that and $3 gets you a cup of coffee at McDonald's. Okay. Had to raise it from 2. All right. I don't make any decisions for clients. I make none based upon the current hot trend. I make 0. Okay. Because the current hot trend doesn't do anything for me. So the same thing with international. International's done really well this year. I'm not changing my mind based upon 1 year. In January, you'll see a study about that at Bootcamp. I'm not changing my mind based upon 1 year. So if people come to me about gold or silver or international, okay, you've heard this before, but I'm going to give you the story to close. Okay. So let's see. Daniel, turn your microphone on, bud.
Yes, sir.
All right. So if Daniel is coming to me and he's like, Tennessee connection here, and he's like, man, I want to get into gold or silver, or I want to get into international because it's done really, really well this year. If that's what he's giving me. Hey, Daniel, I appreciate that. Listen, could I ask you a question, Daniel?
Yes,
You know who Michael Jordan is, obviously, right?
absolutely.
Okay, so let's say that you and I and Michael Jordan are on the same basketball team. And tonight, dude, you are hot. You've got 30. You are hot tonight. Mike's only got 25. We're only, yeah. So you got 30. Mike's only got 25. We're down by 2, 3 seconds left. We're inbounding the ball. Dano, who are we throwing the ball into?
We're throwing it to Mike. I may be hot, but he's consistent.
Oh, see, that's a layup when he gives me that line. Okay.
Yeah.
That's what I would lead to. Okay.
Yeah.
Never had anybody say throw it to me. Never. Okay. Never. They say, I'm gonna throw it to Mike. Yeah, but Daniel, you're hot tonight.
Yeah, I am.
But you still want to go to Mike?
Yeah, I don't want the pressure.
Why do you want to go to Mike? Based on what?
Based upon his performance all the time. I'm having a good night. He's got a good career.
Okay, all right. So you're going to go with history and averages, not the one time, right?
Correct.
With that in mind, what does history tell us, okay, about gold? Okay, gold for the last 3 years, gold for the last 5 years has underperformed. The last 10 years, the last 20 years, the last 30 years. If we look at this one, the past 45 years, gold has underperformed the market quite substantially, by the way, 1 million to 19 million. Okay. If we look at 95 years, gold has underperformed stocks significantly. If we look at a 219-year time period, gold has underperformed stocks significantly. $1 in gold, the purchasing power at the end of 2021 was $4.06. That's after inflation. In the stock market, $1, the purchasing power was, if you look, 2.3 million. Okay. If you go back to Roman times, Wall Street Journal, right? Gold had the same purchasing power as 2,000 years ago in Rome. Are you sure you want to go to Mike, Dano?
Yes, I want to go to Mike.
All right. So with that in mind, then we don't want to change our strategy and go to something that has been hot recently with your investments, do we?
No.
Okay. So that's a little longer than I would normally tell, but I got all these things stacked back to back to back. So, okay, that's a story that I'm using. Now listen, I may look stupid, okay, but if International keeps winning year after year after year, I'm going to reanalyze this process. But I'm not going to reanalyze for 1 year. Daniel's hot tonight. So what? He's probably going to throw an air ball because of the pressure, or Jordan's probably going to drain it. I'll go with the track record. Sorry, Daniel, didn't mean to hit you that way. Okay.
Yep, no worries.
He'll have alligator arms, I can't get it up. Okay. So how about real estate? How about real estate? Well, over the last 45 years, how's real estate compared to the stock market? Little weak. Now here's the problem. Everybody knows somebody that I had this one piece of land that I paid 62 grand for. A Quick Trip gave me 800 grand for because they wanted to build a store there. Well, that's fantastic. That's like the one guy that hit the lottery, or the one guy that won at the casino. I wouldn't stake my reputation on that. Okay. So averages, history. Okay. What about a longer time frame? What about 95 years? Stocks and real estate. Same number.
Same as gold.
Yep, same as gold, right? So gold, real estate, silver. Hey, listen, real estate will appreciate. I'm not anti-real estate. I just know it doesn't compete with the market. Okay. Unless you got that one piece and it's like, well, hey, congratulations. You did awesome. I wouldn't bet my future on that. I wouldn't do it again, but I would go, great job. Okay. Let's go through some client examples. All right. Some client examples. Isaac will like this one. I think you were in it. Okay. So I don't remember if you were Elliot. You'll know in just a second. All right. So I left Gary's name up here in case anyone wanted to call him for him to be our financial advisor when we're done. All right. I want you to look at this plan. The product name is the Prosperity Plus Individual Retirement Annuity. He has averaged 2.59% since 1999 with the Prosperity Plus Individual Retirement Annuities.
It's not saying who it's prosperity for.
Yes, Prosperity for F&G
Prosperity
annuities.
for Gary, Swiden.
Yeah, and Gary Swiden, the rest.
Prosperity plus commission.
Yeah. So is that like unbelievable? So you have to not let the words get in the way of the facts. Okay. So let's look. All right. Here's the appreciation fund over the exact same time period. Okay. It averaged 7.92% net after fees, right? 5,000 grew to 36,000. Now I understand it's only a $5,000 investment. If that's 50, he's got 97,000 in the annuity, right? Or 266,000 in the investment. If that's 500,000, all money is important to people. This was important to him. But really, Prosperity Plus? See, the trash value guys, right? They get people to panic when the market's ugly. So let's look, okay? In the appreciation fund, he put the money in. After the first year, he's negative 3.48. Okay. Then we got a couple years in a row of negative 3, negative 17. His 5,000's at 38.96. This is the 2002 debacle. This is where you earn your money, Mr. and Mrs. Advisor, by reminding the client of the objective and by staying on track with the objective, because we know 76% of the time the market is up. We know that. He happens to have 3 of 4 years in a row ugly. Okay, well, I mean, okay. What do you do? That's just how it is, right? So then he's got another ugly year, 2008, 28%. Then over here's got a couple more ugly years, -2, -12, right? But history says, right, the market's positive 76% of the time during his time frame. The market was positive 75% of the time. Oh, I did that through, yeah, I did the 225, all right? So we need to believe in the numbers that truth is truth is truth. He got sold that because he was scared of the stock market. Right? We're moving it, obviously, right? The process is happening. Were you running or Elliot?
Elliot was, I just helped you fill out the paperwork.
Okay, I needed that. Okay.
Bad.
Administrative assistant, yeah, I am
You know, I've
that.
had called Gary. He passed away 4 years ago.
Oh, okay,
Probably won't be able to get one of those right now.
okay. All right. You had another client with him?
No, I just looked it up.
Oh, okay, all right. So, fine example, what you and I would have done, what the insurance guy did. Significant difference for the client. So I'm going to put you in the spot. Justin used to work with a life insurance company, but fortunately he was referred to us and left them. Okay. They didn't teach anything. You didn't learn anything like this stuff, did you, when you were there?
No,
Why do you think they didn't teach you stuff like this?
because they make a lot of money selling whole life.
Exactly. They make a lot of money selling life insurance and annuity. Yeah. So they don't want you to know. We want our reps to know everything, and then figure out what's best for the client. Client example 2.
How
Okay.
old was that guy when he took that out in 99?
I gotta think. He is,
See now.
I'm trying to think. He's late 50s, early 60s right now.
So 35.
So he's in 35,
Yeah.
30s?
Yeah.
Great product.
Yeah. Yeah. Great product.
I would have put 10 in there.
Yeah. Yeah. Okay. Now, okay. So there's that client example 2. All right. This is a client of ours. Okay. And we're just going to walk through what's happening in their life. And I'm going to share with you I'm going to give you some examples of, okay, what I'm thinking of what we're going to do. So here's what they currently look like. They're retiring in 2 weeks. Or 3 weeks. Been clients for a long time. Okay. So this is their current scenario right here. Okay. I'd met with them a month ago. Planning retirement. I meet with them every year, obviously. We just met and then we're talking about selling this building and trying to figure out what to do. And they listed it at a price higher than they thought they could get, and they got a full price offer immediately. No contingency, 150,000 cash down. Seems like a probable close. A person that owns a building next to him said, I didn't know you were selling, I would have bought it. Would you ask for it? They told him and he said, if that guy backs out, I'll take it for that. So I think they're going to retire. I think it's going to happen. Strong buy signals. Okay. So they came to me and said, what do we do? How do we do this? Okay. So I'm going to share with you well, I'm going to give you just a moment or two to think a little bit. Okay. You're driving them crazy. Okay. What would you do? Okay. How would you help the client retire? Okay. How would you help? What would you do based on what you're seeing? You just think a minute or two, and then I'm going to unravel. Here's what I'm going to do. Right. So they need income starting in January.
What is the MA?
Manage account. Manage account.
Why don't you take it all and lump it all together in a prosperity plus?
Yeah.
I thought that guy died.
Yeah.
Find somebody else.
Okay.
And a whole life.
Cheers, son. So think, how would you provide retirement to this client?
So they're gonna have to pay $200,000 capital gain out of the 500?
No, 500 is net. The 500 is net.
Oh, okay.
500 is net.
So that's already paid. The capital gain's already paid.
It will be in January when they get the money, or they'll pay it the next spring, but yeah. They're closing in January.
So actually you get 700 grand when they.
Yep.
Okay.
Yep.
Then they'll owe 200 grand next,
Yeah.
2047.
Correct. Give you one more minute to think about what you do.
Are there socials? Is that 50%? Or you're giving?
No, that's the real estimate,
Okay, so you're
15 in
giving,
the
okay,
grand,
gotcha.
Yeah. and I'm using half of it in my example. I'll just use half a social. Even though they'll get the bigger number at the start, and I rounded it, they'll get the bigger number at the start, but long term, I don't see that lasting. So that's why I just use half in my estimates max when I'm using social. And if we're younger, like your age, 27, you might get a supersized meal, maybe once a month out of your social.
I opt out of that.
You'd like to, if you're a pastor, yeah. 30 seconds. You were in this one. Or maybe that was the other one you were in.
I was in the first one.
Is the retail simple part of the business that he's got right now?
Yes. Okay. So here's what we're going to do in January. Okay. Number one, I'm going to roll the simple into his managed account IRA. Okay. Because he likes managed accounts. Number two, I'm going to move the retail Roths to managed account Roths. Okay. He has plenty of money. You can get an exception. Because he's got, they got a lot of money with us.
An exception for being below 25 grand.
Yeah. Okay. We're going to start Social Security depending on how the capital gains will affect it. And I told him, I want you to talk to Social Security and your tax advisor. I'm not going to jump in the middle of that. Okay. I would be really careful giving Social Security and tax advice. If something goes wrong, I want his tax advisor to have been the person that said the wrong thing, not me. So they're doing the reconnaissance on that. If that will affect it, then we'll start social in 2027. If not, we're going to start social in 2026. Okay. We're going to start taking income from the TOD account to 500,000. I don't want to take money from a traditional IRA because of the $200,000 of capital gains. So we're going to take money out of the transfer on death account, and that will supplement our income. If we don't start social this year, we'll take $5 grand a month this year. If we do start social, we'll take the balance between $5 grand and whatever social is. That will be tax friendlier than taking money out of traditional IRAs. We could take money out of Roths, but we'd kill them. And I want to keep the Roths for 2027 and beyond. I want to keep the Roths. So Roth is the last money that I want to spend, or at least after traditional IRA money as a minimum. You could argue with stepped up cost basis, you'd want the non-qualified money last because of the tax law change in 2020, where non-spouse beneficiaries must take all the money out within 10 years of death. With a non-qualified plan, the stepped up cost basis could potentially be more attractive. But you look confused.
You're talking about the cost basis of.
If they die and the kids get that final
Oh,
grant.
okay, I was gonna say.
Yeah.
'cause I thought-
Yeah. I'm sorry. I should have been clear. Thank you,
Okay.
Tim. Okay. So the Roth is at least after the pre-tax money, if not last. So those are 2026 actions. They'll tell me what they learn about the capital gains affecting social, and then we'll make a decision. 2027 actions. We're going to start income from traditional IRAs then, because they're going to be in the 12% federal tax bracket. I want to pay taxes in the 12% bracket. Okay. No, actually, I don't. I like paying in the bracket I'm in, but for them, okay. Then we're going to start doing Roth conversions in 2027 because of the 12% tax bracket. We want, listen, reasons behind that. We're in the lowest tax rates in any of our lifetimes right now. Okay, with the permanent tax cuts that got put in place this year. Permanent until the other side of the aisle controls and then changes it. But I mean, they're permanent for now. Okay. So I want to pay taxes now versus whatever they could be later. In addition, they aren't going lower, that's for sure. So the example that we use a lot of times to teach that concept very quickly, right? Mark, let's say $10,000 in your traditional IRA. If that gets a 10% average annual rate of return, that's $45,000 in 15 years. Would you rather pay taxes on 10,000 now or 45,000 later?
The 10.
10,000 now. Now, what if taxes are the same, still low? I'd rather pay taxes on 10 than 45. But if taxes are any higher, I'd really rather pay taxes on 10 now than 45 later. So that's one I use all the time with people. $10,000 at 10% is 45,000 in 15 years. If we leave it in your traditional IRA, you're going to pay taxes on the 45,000 later. Mark, if we convert that to your Roth, we'll pay taxes on 10 now, the $45,000 later is tax-free. Share with me your thoughts. And people can figure that out. Okay. Let's talk about market fluctuation before we go to break. Okay. Volatility does not mean loss. But many people get volatility confused with, oh, I lost. No, you didn't lose unless you sell. Okay. So here's an example of the appreciation fund versus a 5%, like a CD, a fixed 5%. Okay, over the last 30 years. All right. $10,000 initial investment. The 5% cash in the bank is $43,000 today. The appreciation fund is $179,000 today. 5% in the CD, 10% net on appreciation is actual history. How do we get people through the ugly times? I did a side-by-side comparison for you here. Okay. So this is 30 years. The first year, they'd had more money in the CD than they had in the appreciation fund because they paid a fee to put the money in. Let's go down to 2001, 2002. Ugly 2 years in a row. They lost -3 and -17. But let's look. At the end of that 2 years, they had 20,586 in the appreciation fund. They had 14,775 in the CD. Even though you went down, you still had more money than the bank. And then it recovers, okay? Let's go to the balance of the 30 years. This might be an interesting thing for you to create, to have, to like show people that are nervous about volatility, okay? Then you got 2008, where you went down 28%. You went down $11,000. But you still had $6,000 more than the bank after it went down. And then you come to 2018, right? You went down 2%, but you still have got over twice as much as the bank. And then you've got 2022 where you went down 12, you went down 18 grand. Oh my gosh, that's painful. Yeah, but you'd only had 39,000 in the bank, so it's not that painful. And then the ending, 179 and 43. A great example of something of another word story example for you of this, right? Is when people are panicking, did a lump sum and it went way down. Okay. So you talk to them about like housing. Okay. So let's see. Darren Ruggeberg, turn your microphone on, dude.
Hey, Kurt.
Morning, sir. Thank you for being here. So Darren's having a meltdown. You know, the market went down, his pile went down. Okay. He's all nervous. Okay. He's investing for a longer term. He's just upset now because his investment went down a couple $100,000. So, hey, Darren, I appreciate that. May I ask you a question, Darren?
Sure.
Hey, about what is your house worth today?
Oh, 700,000.
700,000. Let's go back to 2006 and say you had a house that was worth 700,000 in 2006. Okay. Do you remember the housing crisis in 2007 and 8?
Yep.
Would your $700,000 house been worth 700,000 in 2008?
Nope.
No, probably 5 or 6, right?
Yep.
At any time during that year, did you and your wife sit down and go, my gosh, we just lost 300 grand on our house?
Nope.
No, you didn't, because your house was still doing its job. It was providing shelter, heating, cooling. The house was depressed and worth less because of the market, but it was still doing its job with you, right?
Yep.
And then a few years later, it was worth 700,000 again, right?
Yep.
Yeah. So let's analyze your investments. You had 500,000. It's now at 350,000. Did you lose any shares, Darren? If we study and look here, you'd show them the numbers. Did you lose any shares?
Nope.
No, you actually have more shares than when you started. Do you see that? I'd be showing him on a statement. Do you see
Yep.
that?
Yep.
So can you see the parallel? It's like your house was actually still a house. It was just worth less based on the market. Today, your investments are worth less based on the market, but you actually have more shares than you started with. Do you see that?
Yep.
So based on history, 76% of the time the market's up, 24 it's down. You're in one of the 24 times. What do you think is going to happen if we give the market a few years to recover? What happened to your house? What do you think is going to happen with your account, Darren?
I'm going to recover.
Yeah, it's going to recover. So with that in mind, let me ask you a question. If you'd have been looking to buy a house, would you have been excited in 2008?
Very, very much.
Yeah, but if you'd have been looking to sell a house, would you have been excited in 2008?
Not at all.
At all. So we have that happening in your investment plan right now. So you really should be excited. We should consider putting more money in, what you think?
Yep.
And you take a person that was in meltdown and they put more money in. Because the emotion is pulled away and the logic goes, dude, this makes sense. I'd love to buy a house in 2008 if I was thinking about a house. This makes sense. Does that happen in real life?
Mm-hmm.
That happens in real life. So thank you, Darren. So I talk to that person. Okay. That's how I talk to them to live through that. Okay. Now, what about a shorter time period? Because that was 30 years. What about a shorter time period? Okay, well, here's the same concept, but here's a 10-year time period. The $10,000, right, is $16,000 in the bank at 5%, and you haven't got 5% over the last 10 years, by the way, in the bank. Okay, and it's $28,000 in the appreciation fund. You've got the same side-by-side story taking place, right? You were upside down immediately. You had a loss. You had another loss. But when you're all done, you got 16,000 or 28,000. Even after the loss in 2022, you had more money. Even after the loss in 2018, you had more money than the bank. It's in mutual funds, it's share accumulation, not value. Share accumulation. The saying, right? You heard the saying, the boy with the most toys wins. I'm teaching you the man with the most shares wins. Does that make sense? Unless you're talking to a lady, you say that, right? So, side by side, showing people this is actual history. This is actually which takes place. You weren't investing for this year. You're investing because you're going to retire in 11 years. So we shouldn't make a this year's decision for 11 years from now, right? We should make the 11-year decision if that's their goal. Make sense? Okay, we're going to run the break here. This was a mutual fund recommendation update thing we put out. A lot of you are on a distribution list, so you got this. This is, if you haven't seen it, this is what it is. If you'd like to see that or not, we're going to take a 5-minute break. We'll be back in 5 minutes.
Right, how many people here are going to lunch? Duncan?
Yeah.
Just wonder how, like,
Just me.
one,
No, all you do is keep track of here and tell mom it's only here.
two, you,
That's correct.
3, 4, 5, 6, 7.
Hey, by the way, yeah, we are, who says there's no free lunch, right? We are buying lunch for the Smiths, for Isaac, for Kelly and Mark and Braden. Who said there's no free lunch? Right, that's not true. All right. 4 minutes, gang, 4 minutes. All right. Pumped up now. Dadgummit. Hey, hey, Wallace, what time is it? Woo! Forgot my watch. I'll never forget that.
You're awesome, Kurt.
That's an inside joke from a long time ago. Okay. All right. We're going to start talking about managed accounts. Okay. And we're going to talk about the attributes of managed accounts. Okay. And I'm going to spend time kind of walking through and going through them. And if you're not on board yet with managed accounts, I really want to challenge you to make this the year you get on board with managed accounts. It is unquestionably a better product, right? Oh, it's unquestionably a better product. Okay. And the clients love it. So let's go through and talk about them. Okay. Attribute number 1, the ongoing monitoring of funds. I called a proactive versus a reactive approach. So when I'm meeting with clients, if they have retail, I'll have their retail statement, right? The staff has my folder for me. And if I'm going to make any adjustments to the funds, I'm going to highlight those funds. So they'll see that. Okay. And I'm going to talk to them about that. In retail mutual funds, maybe I'm going to move fund A to fund B. I always keep people in the same family, so there's no fees. It is a moral recommendation, not a Kurt needs a paycheck recommendation. Okay. So I always do that. I'm going to show them, well, here's what happens, right? With managed account or with retail, right? I have auditor pull up and find out I got 600 clients that own that. Well, calling 600 people, getting 600 people to answer, scheduling 600 appointments. This is not a short-term, quick, easy process. So what happens is we may meet in months or a year based upon your schedule, my schedule, and just simply physically what a person can do. So what I think should happen right now is going to reactively happen when our schedule meshes. Whereas in the managed account, if they think they want to move A to B, they pull the trigger and it's done that day when it's supposed to be, not when our calendars work together. Okay. That's ongoing monitoring of funds, proactive versus reactive. Okay. Number 2, asset allocation. Right. We can build an all-star team with multiple families in the same fee structure. In retail, again, I'm going to keep people in the same family. All right. But what happens, right? Like we use Franklin, which is like a kind of neat because they own a bunch of different mutual fund families. Right. But Franklin isn't the best at every sector of the economy. Neither is Invesco. Neither is Fidelity. Nobody is. Okay. Nobody's the best in every sector. So I take what I think are the best funds and then put some middle of the road ones in there to get the diversification I'm trying to get. In a managed account, I can pick who's really good at this sector and who's really good at this sector and who's really good at this sector and make an all-star team. I can pick the best of the best, but in the same fee structure. In terminology, lots of times I use them is Mark, except unlike professional sports, these people are designed to play together. Okay. Some little stories are how you teach. Okay. Because Mark's going, yeah, I watched the last whatever pro team and it's like, the all-star game or whatever. And it's like, give me a break. Okay.
What do you mean by fee structure?
Okay, in retail, if I have you in Invesco and Franklin's got a really good large core fund, you paid a fee to get into Invesco. Now you're going to pay a fee to get into Franklin. But in managed accounts, we can choose any of the 11 families and switch it around, and there's no charge.
You're talking like BNY and
BNY and Invesco and Dana and all of them, you can move money around between families, no fees. But in retail, you have to pay a fee when you go from family to family to family. So now it becomes, was it that good for Justin and Jane, or did Kurt need a paycheck? So he thought he would teach him it's a good idea.
Right.
That's why I stay in one family in retail. So that's never on the table. That's off the table immediately. So I like that concept. We can build an all-star team in the same fee structure. Okay. Next thing, diversification. Okay. I don't want, when we design these portfolios, I don't want all the managers, buying the same stocks. I have an example for you. In the late 90s, we were doing allocated portfolios at that point in time. And I had a client who was a big shot at a local car dealership. Okay. And I met with him and he said, listen, I'm not getting a high enough rate of return. Our portfolio did like 18 or 19 that year. And he showed me 3 different Janus funds that had 35% per year average annual rate of return. 3. Oof, that's fun of hard to compete with, right? It's like, I don't think I'm going to out jump you if we go to see if we can reach the highest. I don't think it looks good for Kurt, okay, right now. Now, if Levi's on my team, we win, okay? But I mean, it's like, how do you compete with that? So I analyzed those funds. There was like a 60% overlap in top 10 holdings between those 3 funds. They were all buying the same stocks. And the stocks they were buying were hot. So it's like, and I talked to him and I showed him. And I said, and he said, well, if you can't promise me a 20% rate of return each year, I'm going to move my money. I said, you're going to have to move your money. I can't do that. What happened to those from 2000 to 2002? He took a 70% decline in this portfolio. Yeah. Woo! Woo! Because when one was bad, they were all bad. Okay. So I want to use different managers, but I want to make sure they all aren't buying the same stocks also. Because if they all buy the same stocks, might just well have one. In addition to that, I know that I'm just going to pick companies out of there. Dana has a different style than Invesco. Okay. So I want to have different viewpoints of how they're doing things. They could both be large blend, but they don't see things exactly the same, the different companies. I like that because what I'm trying to do is minimize the downside just to breadth. Because if we minimize the downside just to breadth, we can improve rate of return over time. And I think minimizing the downside is way more important than maximizing the upside. You don't lose people if the market did 28 and they did 26. You lose people at -30, -40. That's where you lose people because they can't handle it. I want to avoid those. In terminology that would be talking to, who can I talk to here? Linnell, do you have children? Could you please turn your microphone on? Thank you for volunteering.
I thought I was voluntold.
Yeah, there you go. One of those.
What?
Okay. So here's how I talk to Linnell. Okay. I would say, because I'd ask, hey, who watches the grades closer in your house? You or your husband? And it's like the wife, 99.9999999999% of the time. Okay. So I'd say, Linnell, think of it this way. If your kids are in school and they're getting all A's and they get an F on the final, what does that do to their grade point?
It depends what percentage the final was worth, but generally not a whole lot.
Oh, well, that's the first time I've ever heard that in my life. My understanding is the final has way more impact than quizzes. So I've never heard that. Al, you're teaching me a new one. Okay. So I've been asking this question for like a lot of years. I'm gonna ask you to play along with me. And maybe
Sorry.
no, you're fine. Well, actually, let me answer it like she would, and then we're gonna go the other way. So Linnell, wow, but it would have a negative impact, right?
Yes,
Yeah. So if they were getting all B's and got a C on that final, would that have as much of an impact as all A's and an F?
sometimes.
Are you a retired school teacher?
Yes.
I've never ever heard this in my life, what you're telling me. So it doesn't mean you're wrong. It does not mean that. I've never heard anybody say this ever. Okay. So Linnell's smarter than I am on grading. No questions asked. I won't even go there. I'm going to ask you to play along with me because I've asked this for, I don't know, 25 years. I've never heard this before. So maybe I need to learn. I'm going to ask you to play with me like I would have expected you to answer, and then maybe you need to call and teach me some stuff. So Linnell, if your child's getting all A's and they get an F on the final, what does it typically do to the grade point?
Oh, terrible.
It hurts it, doesn't it? Now, Linnell, if they were getting all B's and got a C on the final, would that hurt as much?
No, not as much.
So what my goal is when I'm running your money, I'm trying to get B's and C's, not A's and F's. I'm trying to make money in the good years and not give it all back in the bad years. Does that seem like that makes sense to you?
Yes, it does.
So even though I screwed up the first two with you, okay, that's a style I'm going to use. I'm trying to minimize downside. She goes, I'm never going on this boot camp again. That guy ain't got a clue on grades. Okay. Okay. So thank you for your help. And maybe I need to learn more from you. Okay. So by having different managers, even if it's the same style, great. But I want to have different styles also. I want to have, we talked about that the last two boot camps. I want to have growth, blend, and value. I want to mix that up a little bit depending upon objective. Okay. Next thing is portfolio rebalancing. It's a really cool deal. We're going to go through those today. We're going to run out of time here to get through all my slides, but then I got part of January done. That's cool. Okay. So portfolio rebalancing keeps the objective and the risk the same now is what it was when you started. And what you're going to find out in retail, it certainly does not do that. So that's an advantage to managed accounts. Okay. Downside monitoring. It is not guaranteed the managed accounts won't go down. They will go down. But what we have seen is a track record is they don't go down as much as retail does because of active management, buying, selling, and rebalancing. We're going to cover that in a slide or two. Next thing, people like the peace of mind that their account is managed daily. Somebody's looking at it. Professionals are watching your account. Whereas in retail, that's not how it's set up, right? You pick 4 funds and each fund is designed to do their thing, but nobody makes them play together. We make them play together in managed accounts. The compensation program is aligned with the investment plan. Okay. We have a vested interest in their success. So I'm going to talk about how I explain the fee structure. Let's see. Patrick, turn your microphone on. Florida man, 75-degree man.
Yes, sir.
So I'm going to talk about fees and how to explain the compensation program. So when I get to this point, right? So Patrick, another thing that people like about managed accounts is how the compensation program is aligned with the investment plan. Here's what I mean by that. On your current retail mutual funds, I get paid when you put money in, regardless of how you do. Okay. But on managed accounts, I don't get paid when you put money in. I get paid based upon the balance of your portfolio. So I get paid a portion of the total program fee that's being charged to you. So if your account balance goes up, you have more money. I make more money. Primerica makes more money. The investment companies make more money. If your account balance goes down, you have less money. I make less money. Primerica makes less money. The investment companies make less money. Therefore, what do you think, Primerica, the investment companies, myself, what do you think how do you think we want you to do?
Well, we want the money to go up.
We want you, okay, so the better you do, the better I do. Versus in retail, I just get paid and put it in regardless. So people have said they really like that concept, that we have a common goal and we want to work together. Does that seem like that makes sense to you?
Yes.
Yeah, and I've never heard had anybody, they go, yeah, I like that, that's good. One of you guys, an appointment I just did where the guy, they're coming in next week, Zoom, and the wife's not gonna be here. They're gonna Zoom her and he's live. Was that you?
Yeah.
Do you remember the words he said? He kept saying it over and over again about how he liked the structure unmanaged.
I like the motivation you guys have.
I like the motivation you guys have. I'm motivated to help you do well. Okay. And the last thing, right? Accountability and transparency, right? They get monthly statements, electronic or online, full disclosure. It's going to show starting balance, what happened, what was sold, what was bought, the fees that were charged, ending balance. You're going to get that every month. You can see it every day online if you want to. Okay. So these are the things that these are the different attributes that I emphasize when I'm talking to people on managed accounts. Okay. Let's go into talk about portfolio rebalancing. Okay. Now, when I said when I have a retail account, I'm going to stop this. When I have a retail account, right? If Mark and Tammy have retail, I have their funds here, right? When I talk about portfolio rebalancing and how we keep the objective like we want it, I can look at their retail account. Mark and Tammy, when we set this up, you got 4 funds, we had 25% in each. You can see now it's not even, is it? This one's got 26,000 and this one's only got 17,000. And you see that? There's each of those managers are designed to kind of do their own thing. Nobody makes them play together. I'm not saying they're bad. I'm just saying. So right now the Dynatech is up the most. Okay. And that's really been performing well for you since 2002. It's really done a great job. The challenge is because that's a bigger part of your portfolio now. When they have a bad year, a bigger part of your portfolio has a bad year, you're going to experience more pain. That's a downside to the retail mutual funds. Do you track what I'm saying there?
I do.
Okay. So it's a way to show him in his own statement, right? So portfolio rebalancing, right? If they're supposed to be in a 60-40 model, here's what happens. Over time, the blue section or the stocks grows faster than the bonds long-term. We know that. So a 60-40 model becomes a 70-30 model. Okay. Now, what just happened to the volatility of that portfolio with more money in stocks than bonds? What happened, Mark?
It went up.
The volatility went up. Did you want to get more aggressive the older you get?
Not usually, no.
Not usually, no. So, and you can see that on your own statement here,
Mhm.
right?
Yep.
Where the managed account has multiple different strategies, how they're going to keep that 60-40 within just a couple percentage points of where they want it. Doesn't it make more sense to keep your risk tolerance where we want it and let it grow over time?
Seems like it would, yeah.
Yeah, seems like it would, right? And then this is a slide that actually shows that hypothetical off POL, right? A 10-year study, right? We got DivStrat, Dynatech, and the Mortgage Total Return Bond Fund. It was a moderate growth of 60-40 portfolio. Beta was 0.71 on this. 10 years later, here's what happened. Here's what it grew to. Okay. 83% stocks, 17% bonds, with Dynatech being over half of the portfolio. The beta went up by it's 28% more volatile than when they started. That's real history. That's what happens in real life in retail. If somebody's not paying attention and watching it, that takes place. Now, I know all of you meet with all of your retail clients every year and rebalance them every year. Right, Wallace? That's everybody does that, right? He's chuckling in the background, okay? Nobody does that. But the managed account does that. Okay. Keeps your risk tolerance where you want it to be. Okay. So let's go through the rebalancing system. How does it work? Okay. Now, you don't need to know all this to teach a client because their eyes will go cross-eyed like Isaac's were earlier and it'll be like over. Were you trying to do like a Keel and Neal impression there or something? Okay, you're gonna have to get bigger, all right? So deposits, okay? Every time money goes in, it buys the undervalued sector of the portfolio. So if it's supposed to be, for oversimplification, if there's supposed to be 25% in 4 different managers, and one of them happens to be down to 24 and one's at 26 right now because of market fluctuation, all the money coming in is going to buy the 23% or 24% sector before they buy anything else. So every time money goes in, a pack, a chunk sent in, they buy the undervalued sector every time, buying low every time. It's cool. Opposite, withdrawals. Every time money comes out or they need cash to have on hand, they sell the upper valued sectors, which is neat. Now, many of you have heard this, but it's kind of fun. I was one of the early people in managed accounts. My mom and dad were the first clients. They started taking money out, and I noticed money kept coming from different places. So I called Primerica, and Primerica goes, "We don't know," because we're all brand new in managed accounts. So they had to go to Lockwood and get figured out, and they discovered, oh, they're selling the upper valued sector. Wow, that's better than I realized. Okay. So that's really cool. Every time cash goes in, they buy the undervalue. Every time or money comes out, they sell the upper value. Okay. So manager changes to holdings or allocations within a model can cause a rebalance. Drift within a sleeve and drift among sleeves. We're going to go through each one of these and teach what that means. Okay. So they're always selling high and they're always buying low. And that's what we want with your portfolio, isn't it, Duncan?
Yep.
Yeah. So I wouldn't try to teach all these to a client again because you're going to wear their backside out. The coolest one is every time money goes in, they buy low. Every time money comes up, they sell high. And then if they see stuff get kitty wampus, they'll just make a move and adjust for you to get back where you want it to be. That's probably as deep as you got to go with most people.
So to be fair, those would only be applicable to deposits if they're making consistent contributions.
Yeah, or they send a piece in, whatever. That's
Or
correct.
if they're
Taking systematic withdrawals.
at the stage where they're
Yeah.
withdrawing money.
Yeah, when I got people take them out every month for
It's like
retirement.
a 401k that they're rolling in, then it's not.
Yeah, if they roll the 401k and it would do it.
But that's just one time.
Right.
Maybe first
Yeah.
getting set.
Yeah. Every time money goes in, every time money comes out. It's just how often. So really, it's cool going in and buying the lower, but where I think it's neater is in the retirement plan when you're selling. Okay, they're only selling upper valued sectors before they sell anything else. So they keep the client's objective where they want it by taking money out every month. Okay, let's go through those. Deposits. This one's pretty obvious, probably we just talked about through, but here's different words, right? Every time money goes in, you're infusing into the undervalued sector. Every time money comes out, they're selling the upper valued sector. Always selling high, always buying low. Whenever money goes in, whenever money comes out. So that is really cool. Now, by the way, this is all part of our program fee. There are some companies, not to mention names Edward Jones, that you have to pay for rebalancing. Okay, you have to have a high enough portfolio, and if you want SMAs, now you got to pay a fee to rebalance also. Well, that's cool. No, this is automatic. You got 25 grand if we do this for you. Okay. Second way, drift within a sleeve rebalancing. So monthly, they review this, Isaac. Monthly, they review this. Okay. So they rebalance positions with a 20% drift. So if you look, you're going to see it spelled out. I worked with Matt Patrick a long time to get this stuff in print like this because it's like, we need to be able to teach this to the field. Okay. So look at the model, right? 10, 20, 20, 20, 30 on the left. Drift takes place. So ABC company got 20% away. The others are not 20% away. They're only going to fix ABC company. So the conversation was what happens with the other money, Matt. Okay. Here's the explanation. Okay. Likely they'll reallocate it to the other sleeves. They could hold it in cash. It depends. If it's going to cause tons of trading, they aren't going to do it. Because that could cause significant tax issues in non-qualified plans. I think cascading is the word he put in here, right? Yeah, cascading trades across, okay? They're not going to do it if it's going to cause major chaos. They'll let it sit in cash. If it doesn't cause major chaos, they'll rebalance the portfolio. So that one is their discretion. What are they going to do based upon what are the implications? They'll always change the 20% one. Lower than that, it depends. So this is a monthly thing. The first one is whenever cash goes in, whenever cash comes out. This one's a monthly thing. The third way, drift among sleeves, if you do multiple managers, okay? Quarterly, they look at this. They rebalance if anything is 10% away. All right? So, and they fix everything in this one. So if you look, you got 4 different managers there, 20, 20, 30, 30. You can look, you got a couple of them that are off. They're going to fix the whole pot back to what they want it to be. Now, company tells us this doesn't happen very much because of the first 2 things. It doesn't happen very much, but it's there. So it's like a safety valve if things really get crazy. Like in 2008, this would have happened. Okay. Or a really, really crazy time. So those are the 3 methods that they rebalance managed accounts with. Again, if you're talking to a client, I'm covering every time money goes in, they buy the undervalued sector. Every time money comes out, they sell the upper valued sector. They also have 2 other methods. The concept of those is this. If anything gets, up farther away than they want, they're going to sell the high ones, buy the low ones, and bring the balance back where they want it. We want them selling high and buying low, don't we, Isaac?
Mm-hmm.
Okay. That's a habit of, I want people to say yes, or I want people to say no. It's really hard. It's really hard to say no. Okay, because your head just naturally goes the other way. Okay. So that's rebalancing. That's a giant benefit, I think, of our managed account program. Keep objective where we want it to be. And if you haven't seen that, have someone that's been here a long time show you a retail portfolio and go, wow, I see the difference. It's pretty crazy. That's why I did that hypothetical to show you what actually happens. Okay. Let's talk about downside monitoring. Okay. Now, I will tell you the company doesn't like me using that terminology. So in the new presentation, it won't say downside monitoring. I'm going to lose that one, I know, but I got a couple others I'm working with them on to change some words. All right. But the concept, this page is the proof presentation, and so is the next one. Okay, which I love.
What do they call
I don't know. I have it.
it? Attorney's word.
I just got it yesterday, so I don't know. Okay, so look, okay. An example of this, right? I'll talk to Elliot through this. Okay. So Elliot, many people think if a portfolio goes down by 20%, it's just got to go up by 20% to get back to even again. That's a common thing people think. But let's see if that's really true. If you got 100 grand and it goes down by 20%, you have 80 grand. If 80 grand goes up by 20%, is that 100 again?
No.
It's actually 96. So what happens is when it goes down, it's got to go up more than it goes down. Here's an example. Back in 2008, for example, the market went down about 40% that year. It takes a positive 67% return just to get back to even again. Now, what if that year we would have only went down 25%? Now it takes a positive 33 to get back to even. Elliot, I'm not telling you that positive 33 years are easy to find, but I am telling you they are easier to find than positive 67 years. Does that make sense to you?
Yeah.
Now, in an even more interesting study to see that, okay, let's look at 2 clients that both invest 100 grand. Both of them get exactly 7% rate of return. Now, the first one is a little bit more an exciting portfolio. It goes up and down more. It's more exciting. The second one is a little bit more mundane. It kind of cuts the peaks and the valleys off. It kind of wiggles like this versus big swings like the first one. Example, the first one has a couple really big years. The second one, not quite as exciting. Then the first one's got 3 pretty ugly years in a row. The second one, not quite as ugly. And then the third one has a big finish. Or the first one has a big finish. The second one, not as big a finish. Now, both get exactly 7%. But Elliot, do you want the exciting 7% return or the little bit more mundane 7% rate of return?
I wouldn't have thought, but I guess I want the mundane one.
Yeah, the one that has the most money wins, right? So that's our goal with your managed account program. We're going to try to minimize the downsides through building the all-star team, having different managers that have different styles in the rebalancing method. Does that seem like value to you?
Yeah.
Yeah, okay.
So this might not be the place to discuss it. If not, we can talk about it offline, but I've been losing sleep over this slide.
Okay.
I don't understand how they can both be 7% unless
Yeah.
we're averaging the
Ne-
percentages
ne-
versus the dollars.
Neither could the attorneys. But it is, they just approved it again.
So how can they both be 7% if one has increased more than the other?
Ask Gary Bergman.
Go back to the grades.
He's a math wizard. Okay, I'm not stoning, I'm saying I'd ask Gary, he's a math wizard. Think about the grades. Typically, except for Linnell's case, okay, the final has more weight. Right? So if you go down more, you hurt the average more. Okay.
Take more to get back up.
Yeah. So
But I'm just saying, like, if you look at 10-year performance, or in this case, 6-year
6-year,
performance, you look at
Mhm.
if you're calculating based on the dollar amount, went from 100,000 to 140, or 100,000 to 143,000. If you're doing it based on the dollars, there's a clear difference. It can't be the same percentage.
They are.
Well, you got
Here's what we're gonna do, guys. We're not gonna spend a lot of time here, okay? I would talk to Gary, literally, because he's a math smart brainiac guy, way smarter than I am. Okay. And this is a compliment to you, not an insult. What I'm going to say, it's a compliment because you're very intelligent. I'm not as smart as you on a lot of stuff. Okay. Sometimes smart people have a really hard time because they got to figure everything out. And that becomes an anchor. And we've talked about that. You already know that. Okay. But I want you to have the answers so you can feel comfortable, but let Gary teach you, not me, because it's above my pay grade.
I just added up the numbers, divided them by 6, and both of them average 7.
You're talking about adding the
I
percentage.
added 30, 20, -5, yeah.
Yeah, but I'm saying if you calculate the percentage off the dollar amount.
Do it. Calculate and figure it out.
Yeah.
Yeah, I don't know. But don't do it right now. We're supposed to be training. Do it on your own time.
This is in the managed account presentation.
It's because it's not a straight 7% every year. It's
It's the average.
25%, then 16%, then -3%.
It's
So-
the left column is doing straight average, the right column is doing weighted average.
Okay, there you go. Somebody smarter than me said that. Okay. Who said that? Levi. Okay, I just need somebody really smart and tall to teach me. Okay. You got them both, dude. I'm short and dumb. All right. You even got hair, Levi. You're screwing the system up, man. Telling you. Okay. I used to have hair. Be careful. All right. Let's talk about, again, I'm telling you, the attorneys approved it. And if it wasn't legit, the attorneys wouldn't approve it. I promise. This has been in our presentation since like 2012 or 14. Yeah.
It's in the managed account.
Okay.
I've seen it 100 times.
Okay.
Been laying awake at night.
Okay. Go to sleep. Go to sleep. All right. So let's talk about the key differences our lifetime program has compared to many. Okay. Number one, independent. We run our own business. We decide the managers we use. We have no obligation to any of the 11 companies. Zero. Number two, right? We're compensated on advice, not on funds to use. Our fiduciary responsibility is it. And we're paid based upon how well they do. So really advice is what they're paying for. Advice and logic and calmness. Number 3, non-proprietary, not selling anybody we own. If we had a Primerica SMA in there, you'd go, and I put you in the Primerica SMA, you'd go, why am I in the Primerica SMA? Is he getting paid more? Is there a reason? Okay. By the way, FYI, for you to know, like AGF owns Primerica, except for in the portfolio we sell. It's a bummer. I wish it was in there because Primerica is a great performer, but they want exactly 0 potential issues. So they can't have it in our portfolio, in their portfolio that Primerica sells. They want no potential proprietary. So I hate it, but I love it at the same time because it keeps us totally moral. Last one, rep as portfolio manager, right? If I am the rep and I'm deciding what stocks to buy, what stocks to sell, when to rebalance, when not to rebalance, what fund to be in, what SMA to be in. If I'm doing a bad job, am I going to go, Mark, I'm really doing a bad job. I think you should take your money elsewhere.
Right.
I'm probably not saying that.
No.
Okay. But here they have canned managers. I like that. I like that. Okay. They have canned managers. Justin, you with me? Okay. So 2026 retirement plan limits. Let them give you some updates on new stuff coming up here. Okay. So these are the new limits for 2020. Did I say 2025? Okay. These are the 2026 limits. Okay. You'll see it in the right-hand column. Okay. So you're going to notice they're going to 70 for IRAs, right? They're going to 7,500. And then noticing that catch up is now 1,100. Okay. Cool. More money you can put away. So 8,600 for people 50 and older in IRAs and Roths. Okay. So those are those. Let's talk about IRA and Roth IRA income limits. Okay. So how much money can you make to have things? Right? Married filing jointly, the phase out for Roth begins at 242 and it's done at 252. Can't have one if your modified adjusted gross income is above 252. Single people, you can see 153 to 168. How about deductible IRAs? For us, this is usually when they do the back door. Okay, because there's not a lot of reasons where I'd sell traditional IRA. Okay, when a Roth is available, unless I'm trying to do the backdoor method. Okay. So if you or your spouse are covered by a retirement plan at work, your ability to deduct traditional IRA is limited by your modified adjusted gross income. Married filing jointly, right? Between 129 and 149 is where it phases out. That's for the spouse who's covered by the plan at work. Okay. So things to know if you're going to do the backdoor method. Okay. Let's talk about tax tables. These are the newest tax tables for the year. Okay. So there's 2 slides for this. The most common is single fire and married filing jointly is the most common too. So you're going to see that it's going up to 50,400 for single people and 100,800 for married people, where you go 12 to 22. So you want to know that when you're talking to people about doing Roth conversions and things like that. Okay. And then the other 2 tax tables, right, for married filing separately and had a household, they're here also. Oh, I'm sorry, I forgot to show. The standard deduction is 16 and 32, 16, 1 and 32, 2. Okay, over here, standard deductions are up again. And then for the other 2, you have this. Let's talk about capital gains. Okay, the new capital gains for this year. Long-term capital gains, right? Taxable income for married people. For married filed jointly, 98,000, had to find the right column, 98,900. Right, or 49,450 for single. Right, that's where you go, that's 0% capital gain. Okay, so that's very attractive if you're making carb rate adjustments for clients. Long-term capital gains are taxed lower than ordinary income. Short-term capital gains are ordinary income. So like if you have managed accounts, you can see right on the NetX 360 website, the unrealized gains, long and short, so you know what's happening, which is kind of cool. Let's talk about overcoming objections. Okay. I know this is a slide that you've never seen, except every time I do it, right? 55% of the message people get is body language, 38% is tone of voice, and 7% is content. This is why you want to memorize scripts verbatim. So when you're talking to people, there is zero mental energy going to thinking what I'm going to say, and there's complete energy on communication, body language, tone of voice. Okay? Facial expressions are big because people look at your face normally when you're talking to them. Hands are good too, and arms. I know that sounds silly. It's not silly. It's true. The example that I use every week, every month, you're tired of this, right? But I keep saying it because consistency key, right? Repetition is the mother of learning. In school, the most boring teacher that you had probably stood in one place and talked monotone for 46 minutes. And the classes you enjoyed the most, the teacher was probably walking around, making jokes, changing tone of voice, whatever, right? You know, one was not a better person than the other. One was a better communicator than the other. We think of the same person, and there's not really a better man than him. He is like a good man, like, wow. But man, you couldn't stay awake in his class. Okay. But he is like he's a servant. He's a great man.
Yep.
Okay. So here's today's close. Okay. We'll go through this once or twice. We'll role play once or twice. So Braden, my insurance guy, says that I'd better off investing with the insurance company. It's a better place than the stock market.
Well, Kurt, if the bank, credit union, or insurance company really
Okay,
believe,
I'm gonna help you. You're doing great.
yeah,
Only talk about who I'm talking about. I've said my insurance guy.
oh, insurance.
So then just say the insurance
Yeah.
guy. If I said my banker or my credit
Okay,
union,
yeah.
perfect, great job.
Yeah.
Say my insurance guy goes, I'm better off investing with him than the stock market with you.
Okay, Kurt, if the insurance guy really believed that, don't you think they would also invest their money there?
What do you mean?
So do you think the insurance guy takes your money and walks across the street to another bank or credit union and buys a CD from them to make a profit?
Probably not. No.
Well, of course not. They invested in something they feel will earn a higher rate of return than they are paying you, or they wouldn't stay in business. Doesn't that make sense to you?
I guess I never really thought of that.
Yeah, I agree. Since that's the case, doesn't it make sense for you to bypass your insurance guy and go where they go to have a chance to earn a higher rate of return for yourself?
Yeah, but he said they guaranteed though.
Well, Kurt, if the insurance guy can offer you a guarantee, how confident do you think they are that they can earn a higher rate of return than what they're guaranteeing you?
I suppose pretty confident, aren't they?
I agree. Well, since that's the case, why don't you just go where they go to have a chance to earn a higher rate of return for yourself?
I guess that makes sense.
Bro, great. Let's get started.
Okay, good. Okay. So you'd say if it's the insurance company, then down here you would say, do you think the insurance company takes your money, goes across the street and buys an insurance policy from them? They go across the street to the insurance company, buy a policy from them? Or if it's a bank or a credit, you need to say CD probably, okay?
Mhm.
All that is bypass the middle person in words. That's all it is. It's really hard to fight it because it's like, it makes too much sense, right? So hey, Mutt, my banker said I'm better off going with him with CDs. He said, they're guaranteed more consistent.
Okay, Kurt, I understand. How do you, if the bank really believes, really believe that you don't think they. Okay, Kurt, if the bank really believe that, didn't you think they would invest their own money there?
I never thought about that.
So don't you think you think the bank takes their money, walks across the street, goes to another bank and puts it with that bank to make a profit?
Doesn't really make sense, actually, I suppose.
Okay, of course not. So they invest in something they feel would be a higher rate of return than they're paying you, or they can't stand business. Doesn't that make sense?
I guess I gotta make a profit, yeah.
Okay, I agree. Since that's the case, does that make sense for you to bypass the bank and go directly where they go to have a chance to earn a higher rate of return than for yourself?
I guess it kind of does, yeah.
Okay, great. Let's get started then.
Okay, sign me up. All right. Isaac, somebody send me an email, I'm gonna bypass 74 on, okay? Okay, or 74. All right, so these are the boot camps coming up for next year. Okay, so I'm just sharing that with you. And we're gonna have a few minutes for Q&A, all right? So we don't have a ton today. We got a few minutes for Q&A. So anybody have any questions? Let's go ahead and raise your hand. Let's do them. Well, you've got me so confused, Kurt. I can't figure out what you're talking about. Uh-oh, that's not good. That's not good if that's the case.
I've had a few people really concerned about AI, and these are predominantly older people.
Okay.
But they ask our thoughts on what do you think the implications of AI are going to be in the future, taking jobs away from people. Is that going to hurt our economy? What would your thoughts or response be?
I think AI unquestionably is going to be around. Okay, when cell phones came out, right? People thought that there wouldn't be cameras anymore either once you had a camera on your cell phone. But do they still sell cameras? Yeah, they still do. Okay. People thought maybe there wouldn't be TV because you can watch on your phone. Do people still buy TVs? Yeah. So I believe it will have an impact, but I don't believe if anything, it's going to grow. Technology is going to grow the economy and the stock market because everybody uses it.
Okay.
Think today, have you used a computer, a telephone, television? Have you used any of those today so far? Do you see that ever stopping in your life? Yeah. AI will certainly have an impact. There'll be some negative, some positive. I think it's not going away. I think we need to embrace it.
How do you compete with people who have their money being actively managed with other companies like Baird or?
Okay. So normally what happens is this, right? I'm going to look at how the money, I'm going to ask them well, actually, you know what? I'm going to do this then. Now, if we go over time and you got to run, I get it. No problems. Okay. So when I'm talking to somebody and they're trying to figure out who to go with, some point in time during my conversation, I'm going to go, Justin, if I was you, this is what I'd look for. I'd look for an advisor that you felt was honest and moral. They would look you in the eye and talk to you. Somebody that would be patient with you and answer questions and take their time with you. Somebody that puts no pressure on you. They don't demand you make a snap decision. They're not like, hey, you got 28 minutes and we're done. They'll take time spending time with you. They will patiently answer questions for you. They're not trying to like, I gotta go, I gotta go, I gotta go. Somebody that is genuinely interested in your success, and you've talked to fake or phony people, right? So somebody that you feel genuinely is interested in your success. Maybe they have a vested interest in your success and they really want you to be successful. And somebody doesn't use $12 words to try to impress you with, I'm really smart and intelligent, you should trust me. If I was you, part of your decision-making process, I would probably pick an advisor that has some of these attributes. Does that seem like that makes sense? Tell me, how does the Baird advisor stack up in these areas?
It does pretty well.
Okay, so you've been talking to me for a while. Would you have a preference of how I speak with you versus how they would speak with you?
It's about the same.
Okay.
Next guy too.
Awesome, that's fantastic. So then I think we should do is break down and we're gonna look at how the money's invested. Okay. So do you know the fee structure you're paying right now?
Yeah, I think it's a little lower, but
Okay, so you think it's a little lower? Okay, so you're really not sure.
well, they're actually at 1.2. You guys are close to 2%.
Oh, does the 1.2 include all fees, all charges, all costs?
Well, I guess I don't know for sure.
Do you think you should know?
I mean, I assumed it did.
You assume. So if it did, they're definitely more economical. But if it didn't, how would you feel if you found out you were being misled?
A little frustrated, yeah.
Okay. Do you think patronizing people and mislead you is a good idea?
Probably not.
Problem in that?
I guess it's not. No.
Yeah, it's not. Well, let's analyze. Let's dig in and look. And see, probably not is not an answer. That's why I ask you again, and I'm going to wait for you to answer me. Okay. So then I'm going to look at how's it invested. And we're going to find out because, like, you know, I showed this at Bootcamp and an MPI. Edward Jones, it says in the fine print, this does not include fund costs. Their 1.35 or their 1.4 does not include fund costs. Well, they're not. We tell you everything. This is all the fees. Here's the whole ball of wax. So then I would look at how's invested, you know, because if he says all his, what I'm trying to do here is I'm trying to explain how I do things. In my opinion, this is how I do stuff right here. So I'm trying to want you to like me, okay? And I will tell you the vast majority of the time when I say that, people say, well, I like how you do it better. Because I try to be this person. I know my sons would say, the patient part you need a little work on. That's true. That's true, okay? But this is how I try to be. Because they don't know what's going on. Just like I didn't know what's going on. So I'd look at how it's invested in, right? It's probably got international and too much bonds in it. I'd see if there's lots of stock overlap. And I would dig into the fee structure to find out is it really the real fee structure or not. More often than not, you'll win. We won't get them all though. But more often than not, you'll win. And usually, like for example, if they didn't know what they were really paying. Well, that's interesting because we're going to tell you what you're paying. So those would be the things I would look at doing. Okay, you've been really patient, Trey. Thank you.
Thank you. Yeah, so this may be something to go into later, but I have a question about the new retail securities recommendations you've got. I know like 2 years ago, like a fund like ClearBridge Select was your first recommendation if somebody's just has enough for one. But I've noticed that it's been ticking down over the last few years. And I'm just curious your metric or philosophy on how you analyze a fund to put it in the spots that you put it.
Sure. It's been underperforming for 3 years straight. Okay. So normally if something has a bad year, like Mike has 25 and Daniel's got 30 tonight, I'm not gonna let 1 year change my mind. 2 years I've become more aware. And if I haven't pulled the trigger at 3 years, it's like, dude, something's got to change. Okay. So I'm going to be a little patient. Now, the difference would be this: if a manager changed, and the story many times I would use an example is the Bulls, right? So Jordan, you're familiar with Trey, you're familiar with Michael Jordan and the Bulls, right? Obviously.
Of course.
Yeah. So like in 1988, you know, it's like, dude, in 1998, you know, that was like In 1998, I actually paid stupid prices and went down and watched a Bulls game at the United Center. It was awesome. He had no, I'm off track, but I mean, it was like awesome. He had 20 in the first quarter. It was a man among boys. It was like, this is easy. Anyway, when you went to that game in 1998 and you saw Jordan play, it was like awesome. If you went there in 1999, was it the same experience at the United Center?
Nope.
Not even close, okay? So if a fund manager changes, aka Peter Lynch, when he left the Magellan Fund, 2 years later, they had 40% of the money in Ginnie Mae's, Government National Mortgage Association, because they didn't know what to do. It was the largest mutual fund in business, and he was a magician, but he's the only guy that knew what he did. So Fidelity was like, we don't have a clue what we're doing. So the exception I would maybe make at 1 or 2 years is if like a manager change. It's like, okay, now I don't know. I mean, we just brought in Jim Bob and replaced Peter Lynch. I don't know how Jim Bob's going to do here, but he's got a pretty tough road to hoe. So that's my thought process. 1 year, I'm aware, but not diving unless something dramatically changed, manager changed, something like that. 2 years, I might be thinking about it. 3 years, it's pretty out. I think we need to make a move for the client. Or maybe we get a new fund in that we didn't have before. That's like, wow, I'm not unhappy with Select, but man, there's a new fund. It's like a whole lot better. Well, okay. So I'm going to look at alpha, beta, Sharpe ratio, consistency, the stocks they own compared to other things in the portfolio. That's my thought process, sir.
Great. Thank you.
All right, we're overtime. I'm sorry for being overtime. Merry Christmas, okay? Enjoy Christmas, spend time celebrating family and the birth of Christ. And I'll see you in January. Travel safe. Hey, don't get cold there. Don't get cold there in Hawaii and Florida, okay? Don't get cold, you guys.
Merry Christmas. Happy New Year. Thank you, Kurt.
Kalikimaka.
Thank you, Kurt.
Follow. You said Edward don't thing it said.
Coding.
Yeah. They don't send
Thank you, Kurt.
Thanks for